Hello, and thank you for tuning in to another edition of the Monthly Market Roll, where we provide a look back at the economy, markets, investments, other macroeconomic data for last month, and then we roll forward and we talk about insights on what we think lies ahead. My name is Brad Rathe, Partner Senior Director of Portfolio Management at Waverly Advisors, and I'm joined by
Clay McDaniel, CIO of Private Markets for Waverly Advisors.
So I'd say, Clay, let's get into it. It's been an interesting year to say the least. We're through July. We're going to talk about through July. We're going to start talking about some of the things that have happened in August and some of the things that we see for the rest of the year. Clay, give me a little bit, just through July. What have you seen with markets, and what have you seen so far this year?
Coming into this year, there was less certainty around the economy than we had coming into the prior year. It was pretty clearly directional coming into 2023. The economy was getting better, rates were going higher, corporate earnings were going higher. Coming into this year, a lot less certainty. What we've seen so far, the economy has outperformed expectations. Inflation has come down more than expected. Corporate earnings have outperformed expectations. So on a backward-looking basis, everything has outperformed and supported markets so far this year. Obviously, markets are forward-looking, so the real question is what happens next, and it's a lot harder to figure out what happens next than to tell you what happened before.
Yeah, it's just going backwards is always easy, right?
Yeah.
Putting together, and I think this month really shows what we talk about, diversification and some of the things. Let's get into the presentation here, and really we're going to just talk about shifting markets, what diversification, what's been going on, declining interest rates, kind of the overall equity landscape. But let's talk first off diversification, how you think about diversification and what you've seen so far, kind of this year. This is just an example of last month and how you've seen a rotation, but we've seen rotations all year, right? You've seen it in tech, out of tech. So I think give me a little bit on your thought process around diversification and what you've kind of seen this year.
Diversification is an interesting question. The way we think about diversification is start with there is structural growth in technology that has driven markets for 10 plus years. This is the area that is benefiting from the increased use of data, the falling cost of computing. We're capturing that growth in the market. It's a higher risk, higher return area of the market. How much are you comfortable owning? Markets are very concentrated now in those names that are benefiting the most. And so when we think about diversification, we want to be prepared for those periods where that dynamic tech sector goes down. It went down a lot in 2022. We've had periods this year where it's gone down. And so what will protect us during those periods? And that's really how we focus on diversification, not simply, are we diversified by region? Are we diversified by factor or sector? We really want what works when technology doesn't.
Well, think of the flip side of that, right? We were talking equity and diversification. What does interest rates or fixed income, what role does that play in portfolios and what you've seen this year and how the dynamic, because it's changed a little bit, right? In 22, it wasn't as helpful. What have you seen this year from a diversification and how fixed income fits into clients' portfolios?
The beautiful thing about fixed income today is yields are high. I know that sounds simple, but it makes a big difference when you're earning 5% from your safe fixed income book than when you were earning 0%. When you earned zero, you really had to get creative at ways to generate return in ways that were different from the market and would protect capital when the market rolled over. There are places you can go now. We'll see how long they last, but they've lasted longer than a lot of people predicted, that will be there and protect capital with high conviction in very bad markets. And so that's a great building block for a portfolio. And then you layer on stocks and bonds on top of that. It's so much easier to build a great diversified portfolio today, than it was, say, 3 years ago when rates were at zero and spreads were tight.
Kind of back to equities, right? You obviously work all across the whole spectrum, privates, equities, fixed income. We've seen, this situation last month where if you look at just broad markets, there wasn't as much under it. But if you start going further, and we do a lot of work digging deeper into allocations and how people are structured. In 22, if you're over energy, you had good performance. This is one area that we do a lot of work on. What have you seen under the hood and some of the things that we monitor, looking at sectors and really digging deep? Because we're not just looking at SP 500. We understand all the components and all the factors that are under that. What are you seeing under the hood, and how are we kind of structured right now?
During the periods this year where technology has sold off, traditional defensives have worked. Healthcare sector, utilities, staples. What we try to do within our portfolios is overweight the more protective sectors, but really think about where we're placing, those tilts in our portfolio, because we still want to hold on to that structural growth that's coming from the technology sector, that's coming from those mega cap stocks that have, dynamic businesses. And so you really want to balance, how much exposure you have to those, and you want to balance it with the more productive sectors. And that's how we think about it.
Right. As you can see here, we highlighted a little bit just last month and how when interest rates are falling, which particular sectors outperform. But those are kind of the things and how to be predictive about where we want to position. And this is just, I thought it was a great example. And that's why we put this together, last month. But going forward, and I think most people want to hear about what's going on in August. What do we see going forward? We're 4 months left in the year. What are some of the things? And obviously, the biggest one is, on the Fed. We'll talk a little on that. We had this volatility spike. What were some of the causes of that? And is that going to bleed into the economy? And how do we see what's the state of the economy right now, and how that's going to impact? But let's start off. Every meeting, it seems like we have to talk about the Fed and interest rates. What is some of this? Where do you see this dual mandate and where the Fed is, and how they're going to manage this, over the next, let's say, the rest of the year and going into the next maybe full year?
Or there's two sides of this coin. Most of the last few years, it's been very uncertain on the data. It's a very opaque environment. The Fed has hiked to control inflation, and it was really hard to tell just how tight policy was, how restrictive, is Fed policy on the economy, and the economy's outperformed. And so they've mostly been correct at holding rates higher so far. What we're seeing in the data more recently is a pretty coordinated slowdown. Now, when you start from a hot period, a slowdown looks like normalization. And so the question is the data slowing down to where it should be, or is it going to go past that and into recession? Our view is all signs point to slowdown. There's no signs of reacceleration. So the Fed should get on with it. You probably should have cut in July. It seems like you're certainly going to cut it going forward. The question is how far they have to go to offset the slowing in the economy. Our view is they don't have to go that far. If you look at the reactiveness of consumer credit, of mortgage credit to falling rates, it's pretty reactive right now. There's a lot of pent-up demand for credit if they can cut rates. The labor market, it's been very resilient, far more resilient and far stronger than almost anybody predicted 2 years ago. So we don't have conditions yet where it looks like they have to panic and go a long way. The further they wait, or the longer they wait, potentially the more they have to go. So from a risk management standpoint, it seems like they're going to start cutting in September. Whether they go 1, 2, 3, 4, the next few meetings really depends on the data. Nobody knows what the data is going to look like over the next 3 months. The Fed doesn't know. We don't know. The question is, will they be reactive to that? And there's no reason to think they won't.
Well, and as you can see from this chart, we stair-stepped up, right? We've been sitting here for what is it, a year and a half, one of the longer periods where we've seen no activity. And yeah, it does feel that, you could have a stair step back down. How that works, just like you said, is on the data side and how fast. And, this will definitely be a driver for what we see in markets. However, we did have a bit of a spike, right? We had a little spike in volatility. There was some probably overcrowded trades. There was a bunch of things I think that played into this. What did you see during this period over the last week and a half, kind of the beginning of August. What are some of the factors that you saw, to start this, and what are markets doing right now?
Global markets are all interconnected. And, you think about human behavior. The longer markets go without a volatility spike, the more likely a volatility spike is. People get overconfident. People get greedy. You use more leverage to buy into markets. You see this cycle again and again in markets. This one seems to point to what they call the yin carry trade. We don't really need to get into the nitty-gritty details of it. It looks just like a lot of these different spikes have occurred in history. People get out over their skis, they need to pull back a little bit. We over the balance of this week, the spike happened on Monday. A lot of the key indexes, key indicators are back to where they were before then. It doesn't mean we're out of the woods, doesn't mean there's not more to come. But so far, it's not something that a long-term investor should be losing sleep over.
Because yeah, it did feel very structural and internal to leverage and overcrowded trades and other things. I'm totally with you, Clay. Let's talk a little bit just the economy, and does that type of thing bleed into the economy? What are we seeing, internals on the economy? We look at a lot of data points. You're unbelievable with some of the really great data points, real-time data, a lot of really interesting data. What is some of the real-time data and some of the data points you're looking at? How does that play out for the economy? Because we do know that's the important part, right? How the markets are going to move. You're going to have volatility, but what are you seeing on the economy?
It's important to remember the economy is huge. It's complex. There's a million different sectors and industries. And so how one group of people, how one sector is interpreting the economy can be very different than another group. This has been a pretty weird period. So what we see in the data are the most interest rate sensitive areas of the economy are slowing the fastest. What we've had over the last few years between government investment, coming through from the IRA bill, the CHIPS Act, the infrastructure bill, there were areas of the economy that were very strong and areas that were very weak, and it kind of rolled around. And the overall economy was fine. So at any point in time, you could have felt miserable. Hey, this is a really bad environment. It just happened to be your pocket that was feeling it. I think what we're seeing now is government spending of those bills has peaked, starting to peter off. It's longer dated bills, but the guts of the construction spending are rolling off. You're starting to see more weakness in construction and housing and multifamily starts. You're starting to see a slowdown in consumer spending on travel, things like that. Nothing that you would be like, oh my goodness, we're rolling over. But again, all of it points to, all right, get on with it, Fed. Start cutting rates. We don't know how far you're going to have to go, but every journey starts with a step. Let's just get the ball rolling.
Well, and I think also just thinking about we had a research call this morning talking to all the advisors. I think you made a great point on with interest rates coming down, it just shifts a little bit where the opportunity is. You were talking about real estate and some other things. And I think that's the dynamic of how we look at markets, how markets work is with every shift in, what's going on, it just creates different opportunities. What do you see and where do you see kind of the opportunity, especially on the privates? You're obviously on the private side. What are you seeing, and you're heavy in real estate? What are you seeing there from the privates, and what new opportunities may come around if interest rates do start coming down, which we talked about earlier?
Real estate would certainly benefit from lower interest rates. We have not been active in buying real estate. There's a lot of uncertainty, particularly around commercial real estate. I think opportunities within debt markets in general have been very attractive. Any type of area where you have fresh capital and you have good partners who know what they're doing, the debt side has been very lucrative. I would say in general, diversification. Diversification gets a bad name when something works better than other things do. You've had it at several points in the prior years. I think of all places right now, diversification is king because there are positive expected returns in many places, and nobody knows how the world's going to work out. We don't know what's going to happen in commercial real estate. We don't know what's going to happen in technology. We want to benefit, from that positive environment, but we also want to be protective if we're wrong, if things work out worse than we think they are. And that diversification, I think right now, it's valuable from a downside protection, and you're getting paid. in so many places, that, from a risk adjusted standpoint, you want to have diversification.
Thanks, Clay. Keep up the good work. That was fantastic. Thanks for listening to the Monthly Market Roll. If you like what you heard, have any questions about the topics we discussed, feel free to reach out to Waverly, any of your advisors. They can talk to us, but information on how to reach us is in the description. You can get info at waverlyadvisors.com. Thank you again for watching, and we'll see you on the next video.